FXN, what's up guys? Welcome back to the channel. Welcome back to another video. Guys, as we move along to the next week of our free trading course, welcome back to FXN Trading Group and Trading with Market Makers 2024. Welcome to week 7. So as we get into week 7, guys, make sure that if you have not watched any of the first 6 weeks, go back and watch it under the playlist of FXN Mentoring 2024. For those of you that are new, my name is Mark. I've been trading since 2011. I'm just here to share with you my strategy, and hopefully any part of it will help you better your trading. With that being said, guys, let's get right into it. So this week, we're going to go ahead and first talk about confirmations. So let's get right into it with confirmations. And what are they? So confirmations give us, as traders, greater confidence in each trade setup we evaluate. There are several types of confirmations we can use when evaluating potential trade setups. Confirmations for a type 1 or type 2 pattern include price action pinning to an EMA. So this involves the price touching or closely approaching the exponential moving average, or EMA, signaling potential support or resistance. So in a scenario where you have either a type 1 or a type 2 pattern that we're looking for, ideally we want to have some sort of an EMA that price pins to. Okay, this is just an extra added confirmation of what we're looking for. Secondly is second leg patterns. These patterns often provide strong confirmation signals. So when we talk about second leg patterns, we're specifically talking about railroad tracks, we're talking about star patterns, and we're talking about cord of woods. All right, so obviously railroad tracks, these patterns consist of two parallel candlesticks indicating a potential reversal. Star patterns, these include morning and evening stars, which signal bullish or bearish reversal respectively. And cord of wood, these patterns consist of multiple candlesticks grouped closely together, indicating consolidation phase before a breakout. Basically, if you take two railroad tracks and stack them next to each other, you essentially get a cord of wood. Timing within trading sessions. So for added confirmation, look for a second leg of the pattern to occur during the London or the New York trading sessions, as these periods see the higher volatility and volume. So when we're looking for the second leg, okay, it's very important and it's very simple. The second leg, you want it to be in either the New York box or the London box. If it's not in the box, then it's not a trade that we want to take. In type 3 setups, the confirmations we are looking for include price action stopping at the middle of the Asian range. We're also looking for an 50 EMA also acting as support and resistance, and pattern formation at the middle of the Asian range. So for price action stopping at the middle of the range, you want price to basically go to the middle of the range, and you want that middle of the range to act as a form of support and resistance. The 50 EMA helps or enhances also that same aspect, because on a type 3 setup, you're going to have the 50 also being right there in the middle of the range. So you also want to have that also act as a form of support or resistance, depending on if you're looking for buys or sells. As far as pattern formations in the middle of the range, we're looking for the same aspect as we did for a second leg of a type 1 or type 2. We're still looking for railroad tracks, star patterns, or cord of woods. The main difference is that on type 3 patterns, 95% of the time, you're looking for just a one-legged pattern. You're not going to have a second leg appear. In type 4 patterns, the confirmations we're looking for include an aggressive move from the Asian session. We're looking for a one-legged pullback. We're looking for pattern formation during that pullback. And we're looking for an EMA as support or resistance being optional, because it doesn't always happen. But the main things that we're looking for confirmations are the aggressive move that happens that comes out of the Asian range. Before the London session even starts, you're already seeing an aggressive move coming out and going below or above the Asian range. The one-legged pullback, that's basically after that aggressive move, you get the pullback. Now that pullback always goes to either the top or the bottom of the range, depending on if you're looking for sells or buys. So if you're looking for sells, let's say, you're going to have the aggressive move break the bottom of the Asian range, and then it's going to come back and retrace. That's the pullback. That pullback is going to go to the bottom of the Asian range. Okay, and then once it's there at the bottom of the Asian range, that's when we're looking for a pattern to form. Same thing of either a railroad track star pattern or a quarter wood. Okay, think of a type 4 pattern as basically a type 3 pattern that happens at the bottom of the range instead of the middle. Now, as far as the EMA support, acting as support and resistance, you're not always going to have the EMAs that are there to help you. But if they are there, it could be 50, 200, 800. If they are there at the bottom, they're also going to act as a form of support or resistance. Let's take a look on the charts what I'm talking about with these confirmations. One couple of notes to add before we get to that. Number one is that I'm going to show you some examples with TDI. I haven't talked about TDI, okay, because right now I don't use it. All right, but there is a video that I made on TDI that I will link it in the description below so you can check it out whenever you want to, that literally explains and breaks down the entire TDI concept. Okay, but the examples that I'm going to show you now some of them do have the TDI included as a confirmation, just so you can see what they look like. All right, so that's the first thing. Second thing is that everything that I give you in this video, being the confirmations or later on when we get to the entry triggers, okay, think of these things as the bare minimum and basic settings for this trading system. Settings of any system can be changed to your specific needs. Okay, but it's very important that if you're going to change any of these default settings that I'm giving you, that you make sure that you do it after you have backtesting data to tell you that the changes that you're making are actually going to benefit you. Okay, so take these default settings that I'm giving you now throughout this video and backtest it, and then make adjustments to them. It's okay to make adjustments to them. The way that I trade, you may not want to trade that way, and that's perfectly fine, and that's okay. There's several different things that you can do here to make this your own. Okay, you don't have to trade all of the patterns. You don't have to trade, type 1s, 2, 3s, and 4s. You could just trade type 1s. That's perfectly fine. You could just trade type 3s. Most of my trades that I take, 95% of them are type 3 trades. I don't really care about anything else. I don't care about type 4s. I don't care about type 1s, type 2s. I just resonate more with type 3s during London session, so that's specifically what I look for. Just like in the New York session, I specifically look for continuation trades because those are the ones that I just feel the best at. But for you, someone listening now, you could be the best at type 1 setups or type 2s. It doesn't matter. As long as you find what works best for you and you customize it to you through your own backtesting. All right, so let's get to the confirmation so you can see them on the charts. So here we have a type 2 setup, okay? Here are the important factors of this particular type 2 setup that would make good confirmations. So we have the first leg is right here. We come back up, and then we create a second leg right here. We can see now that the 200 EMA is right there acting as a form of support. And this 200 EMA is essentially what stops it from going lower. So number one, we have the pattern, which is great. It's inside of the London box, which is great. We have the 200 EMA, and then we also have, if you look down at the TDI, okay, take a look at the TDI here so you can see what I'm talking about. You see how the TDI is right at the bottom, okay? This is good. Now, on the TDI itself, guys, here's what we want to see. Okay, let me move this up real quick so you can actually get a better view of it. You see how the first leg is right here, and then second leg, it also makes basically a W. You can see that. Now, the important thing about the TDI itself is that for type 2 setup confirmations, we want to be somewhere in this range. This is the ideal range when you look at the pattern itself. If you're using the TDI to help you as a confirmation, essentially, you want to see the green line. Okay, you want to see the green line around this area, not all the way down here, but right at the top of the line or a little bit above it. That's perfectly fine. Okay, we don't want to see a type 2 pattern and the TDI have, let's say, the green line be up here in the middle. Okay, that's not what we want. We want the green line to be down here in this area. Just like if it was a type 2 that was actually a type 2 sell, we would also want this particular box or the green line, right, to be making like an M formation in this area. Same principle. So what are the confirmations essentially that we have on this type 2 pattern or on this type 2 setup? So we have the pattern itself. It's doing it at the right timing because we're in the London box, right? We have 5 or more candles between the first and second leg, which is great. That's a good confirmation. And then the TDI is also at the bottom of its range. Okay, the first line, which is a 36, I believe, 37. So you have multiple forms of confirmation. So that's what we're looking for, guys. That type of behavior when you have multiple. The more confirmations you have, the more confidence you should have in that trade. All right, guys. Now take a look at this one. This one here is going to be a multi-session, a multi-session trade setup. Okay, where we're coming off of a peak formation low over here, and you can see the pattern itself is basically this right here. Okay, that's the pattern. Now notice that there was a pattern in London, right, which is this right here. But what's the problem with that pattern? The problem with that pattern is that it's going against our directional bias. So because of that, we actually don't trade this pattern, okay? Because we're just coming off of a brand new peak. We're looking for buys, okay? So we get the option for a buy here in the New York session. Okay, so this is a multi-type 1 pattern, and so you can see what are we looking for confirmations. Well, in this case, the confirmations are going to be a little bit different. Here's why: because we just made a peak formation low, right? You can see that we literally just crossed right here to make it a confirmed peak formation low, right? So this is like literally the first thing, the first day after that. Okay, so all of the EMAs have not crossed over yet on like the 1 hour time frame, and that's what's happening right now. That's why you see the EMA is going straight through price, because there's a transition happening. Okay, but we still get the pattern, right? So what are the confirmations for this specific pattern? Well, we're not going to have the confirmation of the EMAs because, again, they're in transition. Okay, but we do have the confirmation of the actual TDI. Okay, so that's one thing. Look at where the TDI is. Do you see this? Okay, look at how deep the TDI went for a type 1. Do you see the difference between a type 1 and a type 2? Also, take a look at what's going on with the TDI right now. Okay, I want you guys to notice this. Do you notice how this first leg is low? Okay, and then when price action comes down for the second leg, you notice how the second leg over here on the TDI is actually higher than the first. Okay, but on the price chart, the first leg is higher than the second leg, right? You basically get this. Do you see that? This is divergence. This is what's called divergence, okay? When price action is going opposite of what the TDI is doing, this is a really good confirmation. This is a really good confirmation. All right, so you have the TDI, you have TDI confirmation. You also have the directional bias, obviously. That's good. You have a multi-session pattern where the second leg is actually in the New York session. So that's what a confirmation would look like, essentially, on this. And then obviously the second leg pattern is there as well. It's going to be right here where you get this star pattern. Okay, that's the second leg confirmation right there. The second leg star pattern. All right, so you have the second leg pattern, you have, you know, all that stuff. So all of it is there. The only thing that's missing really is going to be the EMAs, but you can't have the EMAs right now because you're coming off that peak formation low, and so it's still creating the transition to do that. So the next day, everything will be crossed over, and then you'll start to have the EMAs, essentially where you can use them as pinning to price action. Okay, but this again, a good source of confirmation for a type 1 that's multi-session. All right. So here is a great example of a type 3 pattern. And I told you if you're in a directional bias, right, of selling, which is this is what we are, you can immediately tell that we're selling because the 50 is there, the 200 is up here, and then the 800 is going to be way higher. So you know you're in a sell bias. Okay. Now I want you guys to take a look at this though. Price action comes from the bottom of the range, like I just said. From the bottom of the range, comes up to the middle, and it hits a brick wall. Okay, literally it just hits a brick wall. You can see right there, it's just pinning to the middle of the range. What's above it? The 50 EMA. Okay, it's right there to hold it as resistance. All right, and then we also get essentially we get a railroad track right here. Okay, we get this railroad track. That's our pattern to give. Remember that type 3 setups don't normally produce a lot of like M's or W's or anything like that at the middle. Most of the time you're going to go a one-legged pattern. Okay, so essentially that's what we got here. So the pattern here is like this. Okay, that's the pattern. So what confirmations do we have? We have the right timing because we're in the London box. We have price action pinning to the middle of the range. We have the 50, right, acting as resistance on that. And then check this out. I think this is pretty, let's check out the TDI real quick. So here is the pattern here. Here's the TDI. Do you see how the TDI is also right there at the 50, the mid-range 50 as well? That's another good confirmation. Okay, so that's what we're looking for out of the TDI on a type 3. Okay, we're looking for the TDI to be at or around the 50 as well. Okay, so you have multiple forms of confirmation, at least probably 5. Directional bias, pattern happening in the London box, the pattern itself that's pinning to the middle of the range, the 50 EMA, the railroad track, the TDI. So that's 6 confirmations right there. I don't know how many confirmations you would need, but that's pretty damn good for me. Okay, so great example of a type 3 pattern with the confirmations to go with it. All right, so what we're looking at here is a type 3 pattern that is happening, with the directional bias of selling. Okay, so we're still coming off a peak formation high. All right, now I want you to notice a lot of different things of this, and I'm showing you this because I want you to see what these patterns really look like in real life, right? There are always going to be variations of every pattern, okay? So here's one variation of a type 3 pattern. Now, the most important things I want you guys to notice is essentially, I told you guys that when we're going in a directional bias of a sell, right, and that's what we're doing here, is that the pattern is always going to come from the bottom, right? The type 3 pattern that we want is going to come from the bottom. So here's what I'm talking about, right? So the pattern actually comes from the top but goes to the bottom, and then what happens? Comes right back up, okay? And then goes over. Now, this one is one of the ones that actually make an M formation. So the M that I'm talking about is here. So that's the M formation that I'm talking about. Now, if you, obviously, you wouldn't be able to see that M formation until it's formed, but here's what I want you to notice, okay, is on the confirmations for this, the 50 is all the way over here, all the way down here, but guess what is right there close to the 50 to act as resistance? It's going to be, this is actually the 800 EMA. 800 EMA is acting as resistance for this type 3. The entry on this, obviously, is going to be right here where you get a railroad track. So the railroad track, after the railroad track, that would be your entry. So what do we have? We have the pattern in the box. That's one. Directional bias. That's two. We actually have a pattern on the type 3. That's 3. We have the 800 EMA acting as resistance. That's 4. And then if we look at the TDI, guys, look at the TDI right here. This is the entry, right? This is the entry candle here, the railroad track. Look at where the TDI is, right at the 50. You see that? Right at the 50. Get to notice these particular patterns like this because you can really tell what the actual confirmations are for each of these individual patterns. All right, so here's an example of another type 1. This happens to be a multi-session type 1. So what are we looking at here? Well, as far as directional bias, the directional bias is obviously to buy. Okay, is our directional bias. We're coming from a peak formation low. Now you can see price action moving straight down, right? The pattern itself is right here. Very similar to the other one that I showed you that had the first leg in London, second leg in the New York session, okay? On this one, so let's talk about the confirmations here. The first one is that the directional bias is 1. Second is going to be that we have a multi-session type 1 pattern where the second leg is inside of the box. Second leg also produces a pattern itself, which is a star pattern right here, okay? And then also we're pinning to the 800 EMA. That's great. I love to see prices pinning to an EMA because that just helps solidify the fact that all market makers are doing are just going down here to get more orders. Okay, that's why this is lower. All right, so that's about 5-6 different confirmations, and then if we take a look, at the TDI, where's the TDI at? All the way past the bottom. Do you see that? Now another thing as well is that look at the TDI. This is even, right? But look at price action. Another divergence. Another divergence. So you have the TDI and TDI divergence, right? So you see all the confirmations that you have in place on this particular example. You have easily about 7. And so the more that you have, obviously, the more confidence you should have, okay, in the particular trade setup. So this is a really good example of a multi-session type 1. All right, so here is another type 2. This one is actually a trade out of the edge, right? So here is the first leg here, right? So you're coming down first leg, and then boom, there's your second leg right there, and then you take off. So what are the confirmations in this particular trade setup? Obviously, we're still coming off a peak formation low, so we're looking for buys, right? So the directional bias is there. The trade setup is there, right? We have the second leg pattern is there. It's inside of the London box, super early because we know it's a trade out of the edge, okay? You have price action pinning to the 800 EMA, okay? That's another confirmation. And then finally, let's take a look at the TDI. So here's the TDI right here. Where are we? All right, look at it. We're in that range, right? Do you see that? We're right there in that range. And then also on top of that, this is the first leg of the TDI, and then there's the second leg on the TDI. But when you look at price action, you have basically the legs on equal end. So you have some slight divergence there as well. So you have second leg patterns in the right timing, directional bias, second leg pattern, TDI, and then TDI divergence. So you have about 7 confirmations. All right, so here we have an example of a type 4 pattern, okay? So what are the key elements for the type 4 pattern? Obviously, we have the strong move out starting from Asia and then going right into the London session. You see how it doesn't give any chances for the London session to anything to happen, right? So we have that strong move, and then we get one pullback. Where does the pullback go? Goes back to the bottom of the Asian range. What do we get there? What is this? This right here is a star pattern, right? So that's your pattern to trade down. Now on this one, on type 4 pattern, guys, we don't have a lot of different confirmations. what I have found is a lot of the times the best confirmation that you have, guys, is going to be the fact that you want the Type 4 to happen in London. Uh, and because of the nature of the pattern, where you get an aggressive move that starts out during the Asian range and just moves along into the London session, essentially, most of the time, guys, we're looking for this particular pattern to produce before like 5:30 a.m. So somewhere around that particular range or before, because of the aggressive move, essentially that happens, from the Asian range. So in this case here, this is right at 4:15, but that would be your entry, and then a straight sell off after that. Okay, so this would be an example of a Type 4. So the real things about the confirmations is the aggressive move that started from Asia and going into the London session. Obviously, the directional bias because you're looking for sells. The pullback that happens, and the pullback has to go to the bottom of the range in this case, and then you get a pattern. Okay, in this case, it was a star pattern. Okay, so that's four types of confirmations right there for the Type 4 patterns. Again, the Type 4 patterns, guys, they don't happen very often. Okay, but when they do, you will see this kind of behavior, and that's what I'm trying to get at. They produce the same behavior. Okay, they literally produce the same behavior. All right, guys, so now let's get into London entry triggers. So Type 1 entry triggers. The first thing is you must identify the nearest peak formation. The Type 1 pattern should move away from the peak formation. Second, ensure that there is a stop hunt that clears the top or bottom of the Asian range. Ideal stops are going to be 25 to 50 pips below or above the Asian range, depending on if you're looking for buys or sells. There should be at least 5 candles between the first and second leg. The second leg of the M/W must form within the London box. In multi-session setups, the second leg must be within the New York session. For early entries, look for railroad track, star pattern, or cord of wood formations that create the second leg of the M/W. This is very important because this is when you can start to take the default settings and start to create them yourself, because there's going to be traders that are more aggressive. There's going to be traders that are more conservative. So depending on what style of trading you like, you may like to do certain different types of entries. So for example, if you're an aggressive trader, okay, you may like to take second leg railroad tracks or star patterns or whatever the case may be. And that's going to be like what you do for entries, right? If you're a more conservative trader, you may wait for price to close above, let's say, the 13 EMA and have a crossover of a 5 and 13 EMA on top of that. So generally that's going to take you, a little bit more to wait for on a trade setup. So this is what I'm talking about when you want to customize it to your liking. So you have to start asking yourself questions like, what kind of a trader am I? Do I have the patience to wait for price to close above of 13 EMA? Or do I even have more patience and am I even more conservative that I want to wait for a close of a 13 and 5 crossover of each other? If there is no second leg pattern, you wait for a 13 close or the 5 and 13 crossover. So meaning that if the second leg, right, of the M/W does not produce star pattern, railroad tracks, cord of wood, then you should wait for either a close of the EMA 13 or a crossover of the 5 and 13. So this is where you have literally options, right? If you're an aggressive trader and you don't get the railroad track, let's say, then you could still get into the trade after, let's say, a 13 close, right? If you're a more conservative trader and let's say you don't get a second leg pattern, let's say you don't get a second leg railroad track, right? But you still want to get into the trade. Well, as long as you have a 5 and 13 crossover, then you can go ahead and now you can use that as the entry. That'll be a more conservative entry, right? But again, everybody is different. That's the key point. So if you look at the example that we have here on EURUSD, you can see the first leg was created outside of the London box. That's basically right before the London session started. So we have the first leg there. Second leg is created obviously inside of the London box. You clearly have 5 or more candles between the first and second leg. The second leg produces a star pattern, which is those 3 candles right there. And so the entry of that trade setup is literally the next candle after the star pattern is formed. Okay? That's where your entry is. All right? Now, another thing that you have the option for is you can have a rule for entries where you want a pullback, right? A lot of times we actually get a lot of pullbacks that happen after we get railroad tracks or star patterns or a close of the 13 EMA or a crossover. Okay, that's also another option. So the options here for entry are really endless and very, very flexible. It just completely depends on who you are as a trader and what you feel most comfortable taking. So for type 2, we're looking for, obviously, the same thing, identifying peak formation. Type 2 patterns should move away from this peak formation. Ensure the price action gets stuck at the top or the bottom of the Asian range, depending on if you're looking for buys or sells. So in this case, in the example that you're looking for in the picture there, right, we're coming off a peak formation low, so we're looking for buys. And so you would be looking for price action to get stuck at the bottom of the Asian range. There should be the same thing, 5 candles between first and second leg. For trades outside of the edge, which is this example here, the second leg must form before 4:30 a.m. Eastern Time. On a normal type 2, still, second leg of the MRW must be within the London session box. In multi-session setups, same thing as type 1s. The second leg must be inside of the New York box. For early entries, we're using the same rules. Railroad track, star patterns, cord of woods on the second leg of formation. If there is no second leg pattern, you wait for the 13 close or 5 and 13 crossover. Okay, so the rules are pretty much going to be the same between a type 1 and a type 2. The differences is essentially with where price action stops to create the actual M. Where type 1 patterns break above or below the Asian range, type 2 patterns don't do that, right? They stay at the bottom or the top. So the pattern is created at the top or the bottom of the Asian range. But pretty much everything else is going to be the same between type 1 and type 2 as far as entry goes. So in the example here, we have a trade out of the edge where we have the first leg in Asia, second leg is created at the very beginning of London session. Clearly you have 5 or more candles between the first and second leg, and then the second leg is created on a railroad track. So that's where your entry is going to be. So for type 3s, same thing. Identify the nearest peak formation. Type 3s should move away from that. Price action must move from the top or the bottom of the Asian range and then hit the resistance in the middle of the range. So meaning this is very important that price action must come from the top or the bottom first before hitting the middle of the range. So look at the example that we have here on Pound USD. You see how price action came out of the Asian range, went down first, and then came to the middle of the range. That's what we want. If price action exits the Asian session in the middle of the range, wait until it comes from the top or bottom. So this is going to happen, and you're going to notice it right away. Whenever you have price action, and it's about to be the end of the Asian session box, and you see price action is literally in the middle of the box. It's not at the top. It's not at the bottom. It's literally coming out of the middle. Okay? That is going to be very likely a type 3 setup. But we need it to come to the bottom or to the top first. So let's say in an example like this, if we're looking for sells and price is coming out of the middle, we want price action to go to the bottom first and then come back to the middle to tag the middle for the type 3. Okay? We don't take type 3 setups that are coming out of the Asian range out of the middle. Very important. Look for 50 EMA rejection in the middle of the range. And then we're looking for the same thing, railroad track, star pattern, or a cord of wood formation to start in the middle. That's going to be the ideal scenario. If there is no pattern, then you're still looking for basically a 13 EMA close, okay? Because not every time are you going to have a actual pattern. Always wait for the pullback on the next candle or set limit orders to secure a better entry. So what do I mean by this? So basically, if you look at this example, you see that prices come out of the Asian range and then go back to the middle of the range during the London session. Now, we end up getting basically a star pattern there in the middle of the range that's also pinning to the 50. So look at the confirmations that you have. You have the star pattern, you have price pinning to the middle of the range, you have price pinning to the 50. Okay, after that star pattern, the next candle is going to be your entry candle. If you're a real conservative trader, or if you're the type of trader that wants a specific type of entry, right, you can set orders for, like, let's say a sell limit order. Okay, let's say halfway up the red candle of the star pattern, right? So you can put a sell limit order there, and if price goes there, that'll give you the best possible entry that you could have. Okay, so that's where waiting for the pullback happens, right? If you're an aggressive trader, you're probably not going to wait for a pullback. You're just going to get in right after the star pattern. Everything really depends upon what type of trader you are. Type 4s, identify the nearest peak formation. The type 4s obviously move, again, away from that peak formation. You're looking for the aggressive move that breaks through the top or the bottom of the Asian range. It's going to resemble the beginning of a type 1 pattern, right? Because it's being very aggressive and it's moving, breaking above or the top of the Asian range. Ensure that there is a pullback to the top or the bottom of the Asian range. This pattern will represent one leg with a railroad track or star pattern at the top or the bottom of the range. This type of pattern typically occurs during the London session. So this is a London session only type of setup. All right. So if you look at the example here, you can see price action aggressively moves outside and goes lower below the Asian session. And then you basically get the pullback that comes and touches the bottom of the Asian range. And then, of course, we get the entry after the star pattern. Okay, that 3 candle pattern, there's a star pattern. We get a tiny pullback. That pullback is your entry on that trade, and you sell. Okay, now notice that on this example, the 50 is right there. It's just not right hovering right, right above or right at the bottom of the range, and that's okay. It's still there to help set basically a ceiling for the type 4 entries. All right, so let's go ahead now and let's go back to the charts and let's show you some actual entries here of all of these different types of patterns that we've been talking about so far. All right, so here we have pound USD, and you can see we're coming off of peak formation low. So being that we're coming off of peak formation low, what are we looking for? We're looking for buys, right? In this case here, we have a trade out of the edge. Here's your first leg, and then it works its way down to the second leg right here. Notice that the railroad track here happens right at 315 or so, and then you get a pullback. That pullback is what gives you the actual entry. Okay, so the entry or the setup itself would be something like this. The entry would be here, your stop loss would go below the closest low. Now, in this case here, where's your target? Your target should be 2 to 1. The EMAs are here that you can use in your favor, but if you use them, right, you're getting 30 pips, but it's not a 2 to 1. So the goal here is to always get 2 to 1. If you can't get 2 to 1, then it's not worth taking the actual trade itself. So 2 to 1 target becomes literally like right here. But when you see this, right, this is like really out in the middle of nowhere. You want to use, if you can't use the EMAs for actual exits or for take profits, you want to use either the structure or previous week's low, high, something. All right, one of these lines that you see here or previous structure. In this case, we can use previous structure, which is here and here. So anywhere around here is where we can take profit. You can see we can go all the way up to yesterday's high, or right to the top here of these wicks. And so either one of those is going to give us a 2-to-1 risk to reward ratio, or over a 2-to-1 risk to reward ratio, right? Anything after this that we get after this is a gift. So the confirmations that we have, or the entry rules, is we're trading away from the peak formation. We have way more than 5 candles between first and second leg. In this case, this being a trade out of the edge, we're within our time range because we're below, or under 4:30 in the morning. We get a pullback for the entry. Now, stop losses is going to be something that's going to really depend upon the pair that you're trading. The majority of the time, your stop losses should not go above 20 pips. The only reason that they should go above 20 pips is if you're trading pairs like pound NZD, euro NZD, pound AUD, and euro AUD. So any of the AUD and NZD pairs that are tied to either pound or euro, the pip value on those are going to be extremely higher. So you need to have a higher stop loss. Up to 30 pips max is going to be a stop loss on those specific pairs. The majority of the time, you're going to be 15, 20 pips max. But on pairs that are over 100, sometimes you're going to need to go up to 30 pips. And so the key with those is understanding that the fact that you need to get that 2-to-1 risk to reward ratio is hugely important. So we have the entry here. We don't have the EMAs to help confirm, but we do have the TDI. If you look at the TDI here, we're actually getting divergence on the TDI, meaning that this is going down while the TDI is actually going up. So you get divergence there. So that's a form of confirmation there. So you have the pattern, you have the timing, you have the TDI, you're in the right directional bias because you're coming off a peak formation low. You get a pullback, you're getting more than 2-to-1. So all the things are there, essentially, for this trade to actually be a good trade. All right, so on this trade here, this is also going to be another type 2 trade out of the edge. So the trade setup is here. The first leg is here. Second leg comes over here on a star pattern at the beginning of the London box. We're coming off of peak formation low, so we're looking for buys. And you also get a huge pullback here on this candle. So the trade setup itself is going to look like this. Now the entry is going to be on the pullback, because there's no way you can get an entry all the way up here. That wouldn't make too much sense. So you need a pullback. There's your pullback. Okay, I mean, depending on how much you're paying attention to this, the pullback could be all the way down here, it could be all the way up here. Typically, I like to aim for, if I can get a pullback half the candle, that's fantastic. The target itself, the exit, is going to be the 800 EMA, because that's what I can use for take profit. The 200 is way too close to use for take profit, obviously the 50 as well. So the only option that I would have to take profit on this would be the 800 EMA. Now we're in the right directional bias. Obviously we have way more than 5 or more candles between the first and second leg. Since this is a trade out of the edge, we have that happening way before 4:30. We get a pullback. Our 2-to-1 risk reward ratio is there. TDI really doesn't help us actually in this situation, but we have multiple forms of confirmation on this one. All right, so I'm going to bring this specific example up because I want you guys to understand trades that you might miss. Okay, so here we're coming off a peak formation low, so we're actually looking for buys, right? Although here you can see this is clearly a type 3 setup to sell. So this would be a trade that you would actually miss because you don't want to trade against your directional bias. Now this ends up being a reset up here, right? So this area ends up resetting itself. But you don't know that's actually happening at this particular point in time. Okay, so you're still looking for buys. But this would be a trade setup that you see the pattern as a type 3, but it's trading against your directional bias. So this is an example of a trade that you would actually miss. So here on this one, this is an example of a type 1 sell. And if we look back, we're coming off of a peak formation high, right, all the way up here. So we're still looking for sells. This would be a type 1 sell setup with our directional bias in our favor. Okay, the first leg would be here, this railroad track. You obviously have more than five candles between the first and second leg. Second leg here doesn't really give you a second leg pattern of a railroad track or anything like that, or a star pattern. This looks like a star pattern, but this right here is not an actual big blue candle enough to make it a star pattern. So what do you have to wait for? Essentially, you have to wait for either a close of the 13 or a crossover. So in this case here, this candle right here closes below the 13 EMA, which that right there is actually your second leg. Here on the next candle is your pullback that gives you the entry. Okay, so this trade essentially is going to look like this. Now, where's the exit point on this trade is if you just want a 2-to-1, essentially since you can't use the EMAs in your favor, you can use the structure, meaning you can actually just use the middle of the range, right, as a point of structure as your take profit. That's well over 2.5 to 1 risk to reward ratio. Anything after that, again, would be a gift. Again, you have the pattern, 5 or more candles in the right directional bias. Okay, you have a close below the 13, a pullback right after, and you can see here you get divergence on the TDI as well, where this is basically even straight across and this is going straight down. So this first leg here is lower than that. So that's your divergence there, and that's an extra form of confirmation. There's going to be cases where you guys are going to find that price action comes up to like a 50 or 200 or an 800 EMA like this, and this structure of this type 1 is actually up here, and that's perfect because that gives you even more confirmation if it's bouncing off of a 200 like that. Stop loss on this is very small, obviously, because you have a pullback. The importance of a pullback is huge because it can sometimes make or break the trade setup. And so remember that the trade setups that we want are the right trade setups that's going to give us the highest probability of winning percentage for us. So if this trade setup would not give us an actual pullback, what would that look like then? Instead of a 8 pip stop loss, it'd be a 13 instead. It would still be a good trade, but now instead of going to the middle of the range, you're actually going to the bottom of the range, right? That's where structure is if you look to the left here. That's still 2.5, almost a 2.5 to 1 risk to reward ratio. So again, you have multiple forms of confirmation, and that's what we want. That is the point that we want. We don't just want to take a trade that has just the pattern and the timing by itself. We want to have a trade setup that has 5 or 6 that is just undeniable points of confirmation that you have, that you're asking yourself, like, what else do you need? You shouldn't ask yourself, what else more do I need to be able to take this trade? So here's a trade setup where I think a lot of people might get stopped out at. So this is an example of a type 2 trade that when taken would probably get people stopped out because they weren't ready to make the move during London. And so what I'm talking about is a type 2 here, where this is the first leg, second leg is right here on a star pattern, and then you end up getting a retracement back. If we're just looking at the fact that we're going to take this pattern here, like this, the type 2, right? So the pattern is here, here, and then down, right? That's the pattern that we're looking at. We have more than 5 candles between the first and second leg. We have a actual rejection off the 200, which is actually a really good confirmation. We have a huge move, big fat candle coming down that literally knocks out the previous 2 candles. That's why I call this. It may not be the ideal, star pattern, but I still would consider this a good star pattern because you get a huge rejection at the top and you still have a full body here and a way full body here. Now the question becomes, you get a pullback, you do get a pullback, right? So the trade setup would be only 11 pip risk. Where would you take it to if you go to 2 to 1? It'd be somewhere around here. Right? If you look to the left here, the structure is here and here, so the ideal place really would be probably somewhere down here. It turns into almost a 3 to 1, right? But as this starts to play out, you see what happens, right? And so in this case here, the 6th candle rule would probably take into effect.
where you'd have 1, 2, 3, 4, 5, 6. You're not in substantial profits, you just get out of the trade. So, 6 candle rule is basically an exit strategy, and it's pretty simple to understand. Once you get into a trade, if you're not in substantial profit after 6 candles, and substantial profit meaning like if you're not up 15 pips or more in profit, then you should probably exit out of the trade because the timing aspect is just not right. So think about it like this. If you're looking at this setup here, that this setup, you're thinking that this is the second leg that is going to go down. So if that's the correct setup, there's no reason for them to come up here again, right? The only reason that they're coming up here again is because they don't have enough contracts to make the move that they need to make. So what do? They go back up, grab more traders, grab more buy orders so they can do the sells, and then they drop it after that, right? So here's my point to this. If you were to take out this trade here, okay, and you get out after the 6 candle roll because you're not in significant profit, just take whatever you can, right? In this case, it would be like 5 pips or something like that, 9 pips or something. Take it out, and then you notice the behavior, because it all comes down to the market maker behavior. At the beginning of the US session, it pins the 200 again, and it gives you a railroad track. That right there is another setup. So just because you get stopped out, or you take your profits out, because of the 6 candle rule, if you notice that the market maker behavior is still there, meaning that the high up here was never taken out, it's still a good trade for a sell, because you're still going against your directional bias. So there's no reason why you can't get back in the trade setup here, because you're going in the right direction. So what's wrong? And now you basically end up getting a third leg here of a type 2 that's still pinning to the 200 railroad track, and you get a huge pullback. So now, the stop loss could be anything. It could be 5, 10 pips, whatever, however long you have it here. It could be here, it's 8 pips. If you have it all the way up here, then it could be like 4 pips. Just all depends on you yourself, on what you're looking at here. And the same take profit parts are the same, because you can't use the EMAs because they're above you. So you're using structure at this point. Look to the left. Where's the closest structure? Where's price been to before? Right here. There's yesterday's low line, which is here. You could just literally take it to that. Again, anything after that is a gift. So basically, you'd be getting out. If you hold on to it, you'd be getting out here on this candle, if you follow the 5. But these are setups that you're going to run into, where everything is there, everything matches what you want. You take the trade, but then it moves back, and you're like, what the hell? The reason, you just have to understand the reason that it moved back and went back to retest that same level is because they didn't have enough buyers in the market, because they want to sell. So here's an example on this one here of what most people would probably take as a type 1 setup. Right, you have movement straight down, you have your first leg here, comes up, creates a second leg railroad track and everything. Right? What's the number one problem with this is the fact that you're trading against a newly formed peak formation high is the problem. So that goes back to the first rule, right? If you're coming off of peak formation high, which is what you're looking for sells, you're not looking for buys. So because of that directional bias, essentially it'll keep you out of this trade, and this trade ends up being a bad trade, right? What this ends up being is in the New York session is what it is, right? Because price comes back up, gets rejected right at the middle of the range. Here you have a big fat blue candle followed by 2 kind of doji candles. This is really more like a star pattern, because you get a big fat red candle right afterwards, and you end up getting a pullback right afterwards as well. So what does that look like? On the pullback, because of the pullback, this makes it a viable trade. You go 2 to 1, which is here. If you look back to the left, where is structure? As far as where is price action at? It's right here. So all this entire area here could be used as potential take profit points, right? You're over a 2-to-1 risk reward ratio. That's good right there. If you want to keep following it, right, just follow the 5 EMA. Just keep following the 5 EMA until it breaks above, which is right here on this candle, right? So you end up getting a 50 pip trade on this one. It's almost a 4.5 to 1 risk to reward ratio. Again, the important part about this, why I showed you this, is I want you to understand is that we want to trade away from the peak formation. That's your edge or your advantage. Okay, is to trade away from the peak formation. So on this trade here on this day, this is Euro JPY. What do we have? The US session, right? Right here, pull back right to the middle, railroad track gets rejected, comes literally right back, and it gives you a star pattern here for a trade. We're coming off of peak formation low right here, right? Because this is actually a failed reset. So we're looking for buys anyways. Now, how many confirmations do you need on this trade? If you look at it, we have the pattern. We're pinning to the EMAs. In this case, it's 800 EMA. We have the TDI also making a nice W there. We have more than 5 candles between the first and second leg. I mean, how many more pieces of confirmation do you need? So where do you take this to? You start looking to the left. Your closest form of confirmation is your peak up here. But that's not 2-to-1 risk reward ratio, right? So that right there, right here would be a 2-to-1 risk reward ratio. Anything after that is a gift. It's free money. If we're coming off a peak low, we know that we're not probably going to have structure here to help us, kind of know where to go. If we have to go back to the previous week, essentially, to look for structure. And the structure is right here. The closest structure is right here. All of this. This right here is the structure. So if you want to go to that, you're looking now at a 3-to-1, over a 3-to-1 risk to reward ratio, 56 pips on that specific trade with a 16 pip stop loss, 17 pip stop loss. So how many confirmations do you have on that trade? You got the pattern. It's in the right timing. 5 or more candles. The directional bias is correct. Bouncing off of an EMA. Also, the TDI is also making the same pattern. So again, multiple forms of confirmation. This is what we want when we want to take a trade. Since we don't have a pullback, the entry is literally right after this blue candle. If we had a pullback, we could, get a better entry. But we didn't get a pullback. Some give you pullbacks, some don't. In this case, it didn't give us a pullback. So here's another setup on Euro JPY. This happens to be a type 2 setup. The first leg is here, comes down. The first leg is here, comes down. Second leg, it actually could be considered a trade out of the edge, right? Second leg gives you a railroad track, pinning to a 200 EMA, coming off of, guess what, a peak formation high. So we're looking for sells anyways. So what's the trade setup? Trade setup is this. You get a pullback after that, so that gives you even a better trade entry, right? So 7 pips stop loss. And then where are you going for this? If you just go to the 800, it's a 4-to-1 risk to reward ratio. If you just go to that, it's a 4-to-1 risk to reward ratio. If you don't, you can literally just go to yesterday's low, and that's still a 3-to-1 risk to reward ratio. Because again, keep in mind, we're only using 7 pips to risk. We're coming off of peak formation high here, so we definitely know that if we wanted to, we could really hold this out. We should be able to hold this out for some time because we're going to get super early in on this trade. You can 3-to-1 risk to reward ratio. You go into structure here, yesterday's low. Anything after that is a gift. You can go down to the 800, which is what really makes sense on this one. That's 33 pips. That's a 4.5-to-1 risk to reward ratio. Look at the patterns that I'm showing you, and look how clear the patterns are. I'm not showing you crappy ass patterns because I don't want you to trade crappy ass trades. I want you to only trade the really good patterns that are clear to see and understand what's happening. That's the whole point. So on this one here, we end up having the pattern, the timing. We're coming off of directional bias, which is correct, off of peak formation high. We're looking for sells. We even have divergence on the TDI here. See how this first leg here is here on the TDI? Look at the second leg. is lower on the TDI but higher on the price action. That's divergence. So in this trade setup here, what do we have? What's the pattern here? Pattern here is a type 4 pattern. You can see how early we started moving out of the Asian range, right? And then boom, we spike all the way down to the top of the range here. The 50 though is blocking. You can see the 50 is blocking stuff, right? We're coming off a peak formation low, so we're looking for buys anyways. So what's the trade setup here? The type 4 is a trade setup. So here's your trade setup. You wait for the pullback. The next candle actually gives you a pullback, right here, that you can get into. So you're only risking about 12 pips or so. And then where do you go to? 2 to 1 risk to reward ratio. I mean, even a 2 to 1, look at this, only a 2 to 1 risk to reward ratio. You're not even asking to go back to the top of the range. You're literally asking it to go to the 800. We're coming right off of a peak formation low. So you know this should go way higher than this. And again, you follow the 5 EMA. Follow, 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 follow. Guess what? Here's where you get out right here. So this turns out to be 60 pips over a 4.5 to 1 risk to reward ratio. Look at the TDI bouncing off the 50 here. Bouncing off the 50 EMA. This candle here, this wick of the candle is a clue here. Why are they just wicking the top of the range? You got to ask yourself this. Why are they pinning to the top of the range? Market maker behavior is the clue, is the key to this. So here's another example. This is a type 2, but I want you to pay attention to the fact that most of you might take this super early right here, right? Here's the first leg. It retraces, it gives you more than 5 candles between the first and second leg. You're coming off of a peak formation high up here, right? So you're looking for sells anyways, which is fine. So it's in the correct directional bias. You don't really get like a star pattern or anything like that. But here you get the actual red candle that closes below the 13 EMA, right? So there's your entry trigger right there. You get a little bit of a pullback there. So the trade setup is like this, right? Where would you take it to if it's 2 to 1? It would make sense. You don't just go here in the middle of nowhere. You just go to structure, which is go to the bottom of the Asian range, right? Anything after that is great. So here's the point about this. If you take this trade, you see what starts happening here, right? So we got 1, 2, 3, 4, 5, 6 candles right here. 6 candles, you're not in substantial profit. You get out of the trade. You get out of the trade because it's not the right timing. We think it's the right timing, but obviously there's something going on where it's not the right timing because they're going back up to get more contracts. This is 8:30 news, by the way, so that's what makes that. But right here, pay attention to this right here. Pay attention to the behavior. We know that we're still looking for sells because we're coming off a peak formation high. So pay attention to the behavior of price action. Where's the trade setup here? Well, it's got to be after news. 8:30 news is here. That's why you get this weird looking candle. But after news, what do you end up getting here? It's a 15 pip stop loss. It may look big, but it's really not. It's only 15 pips. But can you get 2 to 1? The answer is yes. You can go back down the structure of the previous week's low right here. Right there. Look. Where does price go to? I mean, it goes even lower than that. You can see you get a 2 to 1 risk to reward ratio. So a lot of times when you take the 6 candle out rule into place, you're essentially going to get out at break even or with a little bit of profit. Or, you might get a small loss. But the point of the 6 candle rule for the exit is for you to get out of the trade, because if this was really the trade setup here to begin with, as far as this right here, this should have kept going down. The only reason they went back up one more time is because they didn't have what they needed to make the move that they wanted. That's it. It's the only reason. So if we start to look back here, guys, you'll see the patterns, you'll see the setups. Here's the type 1 sell that goes with, you know, your directional bias. Previous day before is a continuation trade. This is going to end up being a type 4 pattern that pins to the 50 in the US session straight down. You can see the pullback candle. That's going to be your entry right here. After a while, you can literally start to see where the setups are. This is a trade out of the edge right here. This is a trade out of the edge. First leg here, second leg here. The entry is on the pullback here, straight down. Coming off a peak formation high, you should look for sells. So I only want you to focus. I only want you guys to focus on finding patterns that go with your directional bias. Because at the end of the day, remember that you're trying to build some type of consistency. And it's pretty easy to build consistency when you're looking for trade setups going in a directional bias based off of your market structure of peak formation highs and lows. Or peak formation highs, lows, resets.
All right, guys. So I hope that this week's video has brought a lot of clarity as to what you guys are looking for every single day within the patterns of that we've talked about over the last 6 weeks, and more specifically, obviously, the entries and confirmations that you're looking for each specific type. We went over examples. We broke everything down for you, so you should have a very clear idea as to what we're looking for and what we're not looking for. One of the most important aspects, guys, about trading any strategy is the fact that you as a trader have to have patience with what you're doing, especially if you're trying to do this for real and you're trying to do this as a profession. You're trying to do this consistently over an extended period of time for the next 5, 10, 20 years. All right? Understand that you're not going to get a setup every single day. Understand that it's not going to be easy. Understand that you're going to have losses. There are going to be setups that look absolutely perfect, that meet all of your qualifications, that you're going to lose. Expect that, because it's going to happen. But the important thing now is now you have the directional bias, you have the patterns, you have the entry triggers, you have the confirmations, right? You know what you're looking for now. Now take this information, go back into the charts and start back testing it and start to create your own plan with your own rules based on your back testing. Guys, as always, if you have any questions, leave them in the comments. As always, guys, please make sure to subscribe to the channel. Guys, like the video, share the content, would be much appreciated, guys. And enjoy the rest of the week, guys, and we will see you in the next video.